Hello and welcome back. In this video we address our third learning objective for this topic, which is to outline the auditor's responsibilities for fraud risk assessment and fraud detection. We know the auditor's overall responsibility is to obtain reasonable assurance that the financial report, taken as a whole, is free from material misstatement, whether caused by fraud or error. We also know that fraud is always going to be qualitatively material, as it is an illegal act, regardless of the amount of the fraud. The problem for auditors is that the inherent limitations of an audit mean that even a properly conducted audit may not detect fraud, given that fraud is a lot harder to find than errors. But at the same time, there is an expectation on the part of users and the public that a properly conducted audit will detect fraud. From a legal perspective, the Pacific acceptance case requires auditors to be alert to the suspicion of fraud and to comply with auditing standards, which change to meet changed conditions. Taken together, the expectations gap around fraud has now been addressed by the auditing standard ACCT90014, which imposes an increased responsibility on the auditor for fraud. The auditor now has to separately and explicitly consider the risk of misstatements caused by fraud instead of just misstatements in general. ACCT90014 summarises the objectives of the auditor in fraud auditing as A, to identify and assess the risks of material misstatements of the financial report due to fraud, B, to obtain sufficient appropriate evidence regarding the assessed risks of material misstatement due to fraud through designing and implementing appropriate responses. So in other words, the auditor has to respond to the fraud risks through conducting audit procedures, and C, to respond appropriately to fraud or suspected fraud during the performance of the audit. So, auditors must maintain a level of professional scepticism as they consider a broad set of information, including fraud risk factors, to identify and respond to fraud risk. You should recall that professional scepticism means an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatements, and a critical assessment of audit evidence coming from documents and records and responses to the auditor's inquiries. In maintaining a questioning mind, auditors need to set any prior beliefs about management's honesty and integrity, and should consider the potential for management override of controls. At the planning stage of the audit engagement team need to meet and communicate with each other in a process of brainstorming, addressing questions such as how and where they believe the entity's financial report might be misstated, how could management perpetrate and conceal fraudulent financial reporting, how the assets of the entity could be misappropriated, and how the auditor could respond to these circumstances. This fraud risk assessment is one part of the broader risk assessment required by ACCT90014, which requires the auditor to understand the entity and its environment, including its internal controls. In addition to the brainstorming session of the audit team, other sources of information about fraud risk come from the auditor making inquiries of management and others of their views on fraud and how it was dealt with, from considering any unusual or unexpected relationships that have come out of the analytical procedures, considering the risk of management override of internal controls, and considering any other relevant information. The auditor must also obviously evaluate whether the fraud risk factors related to the three conditions of incentives or pressures, opportunities, and attitudes or rationalisation are present, as we covered in the second video on the fraud triangle. This diagram summarises our discussion on the sources of information that the auditor obtains in order to make an assessment of the risk of material misstatement due to fraud. Most importantly, all of the information about risk assessment must be documented to show that the auditor has actually complied with ASA 240 and done the right thing. Of course, the auditor's response to the identified risk must also be documented. After having identified and documented risks of fraud, the auditor needs to respond to the risk. The auditor could change the overall conduct of the audit by allocating more experienced staff, or perhaps even fraud or forensic accounting experts to the team. They obviously need to perform audit tests on the specific risks that have been identified, so which ones will depend on the risk and assertion identified, and they also need to address the possibility that management may have overridden controls. This could involve examining adjusting journal entries to determine whether they are genuine and valid, reviewing accounting estimates that management makes for biases, and evaluating the business rationale for any significant or unusual transactions. This concludes our discussion of the auditor's responsibility for fraud risk assessment and fraud detection, as set out in the auditing standard ASA 240.